Every time a bank issues a loan, it creates money that did not exist 1 second before, not from deposits, not from reserves, but from nothing. And this is not a secret. Central banks have published exactly how it works, and most people were just never told where to look. Here is something that should be common knowledge, but is not. When a bank issues you a loan, it does not take that money from someone else's deposit. It does not retrieve it from a vault somewhere. It types a number into a computer. And that number, that new balance in your account, is new money, created at the moment of lending from nothing. This is called money creation through credit, and it is not a fringe theory. In 2014, the Bank of England published a paper titled Money Creation in the Modern Economy. In plain language, it stated that banks create new money every time they make a loan, and that the common assumption that banks lend out deposits is simply wrong. The paper exists. It is publicly available. It has been publicly available for over a decade. Most people have never read it because most people were never told it existed. By the end of this video, you will understand exactly how this works, why it matters to your daily financial life, and what knowing it changes about how you see money itself. Let us start from the very beginning and explore this concept slowly and carefully and see where it takes us. Let us walk through exactly how this works, step by step, because once you see the mechanism clearly, you cannot unsee it. You walk into a bank and apply for a $50,000 loan. The bank approves it. Here is what most people think happens next. The bank goes to its vault, retrieves $50,000 from deposits, hands it to you. Here is what actually happens. The bank opens your account on a computer. It types in $50,000. Your account now shows a balance of $50,000. That money did not come from anywhere. It was created by the act of the bank recording a liability, your loan, and simultaneously recording an asset, your new deposit, 2 entries on a balance sheet. One of them is new money. Now, here is what makes this important. When you spend that $50,000, it enters the economy. It becomes someone's income, someone's business revenue, someone else's deposit at another bank. And when it is deposited at that other bank, that bank can use it as the foundation to create more loans, more new money. The process repeats, multiplies. The original $50,000 loan can ultimately generate hundreds of thousands of dollars in total new money circulating through the economy from one loan, from one set of keystrokes. Now, here is the question worth sitting with. If banks can create money through lending, who decides how much gets created, who controls the dial, and what happens when too much is created? That is where this gets personal. This is the part most financial education completely skips. If commercial banks create money through lending, then the total amount of money in the economy is determined by how much banks lend. And how much banks lend is influenced by a set of forces that most ordinary people never interact with directly. The first force is the central bank interest rate. When the central bank sets a low interest rate, borrowing becomes cheap. Cheap borrowing means more loans get taken out. More loans means more money gets created. More money in circulation means each existing unit of money buys a little less. Inflation. When the central bank raises rates, borrowing becomes expensive. Fewer loans get taken out. Less new money gets created. Inflation slows. This is the basic mechanism of monetary policy. The central bank does not print money directly in most modern economies. It adjusts the cost of borrowing, which determines how much money commercial banks create through lending. The dial is interest rates. The hand on the dial is the central bank. Now, here is what makes this deeply unequal. When interest rates are low and credit is cheap, the people who benefit most are people who can access large amounts of credit. Wealthy individuals and corporations borrow large amounts at low rates. They use that borrowed money to purchase assets. The new money flowing into asset markets pushes asset prices up. People who own assets see their wealth increase. People who do not own assets and cannot access significant credit see prices rise around them as the money supply expands. but do not see corresponding increases in their wealth. This is not a side effect of monetary policy. It is the documented, predictable outcome. When the money supply expands through credit creation, the gains flow to whoever has first access to the new money. That is almost always financial institutions and large borrowers. By the time the new money reaches ordinary wage earners, it has already inflated the prices of things they need to buy. The money supply expansion that was supposed to stimulate the economy arrived at your door as a higher grocery bill, not as a higher wage. This mechanism has a name in economics. It is called the Cantillon effect. Richard Cantillon described it in the 18th century. 300 years later, it still runs. Every time rates are cut, every time new credit is created, every time the money supply expands. The people closest to the source of new money benefit first. The people furthest away pay the cost last, and ordinary wage earners are always furthest away. If the Cantillon effect just explains something you have felt your whole life, but never had words for, stay with me, because understanding who creates money and who benefits first is only half of this. What this does to your purchasing power, specifically, and what you can actually do about your position, that is what comes next. Here is where this becomes personal, and it is a realization that can be quite profound. Because the money creation process we just described is happening continuously, every day, and it is an ongoing process. Every time a bank issues a mortgage, new money enters the economy, and this is a regular occurrence. Every time a business takes out a loan, new money enters the economy, and this is also a common event. Every time a government borrows from the financial system, new money enters the economy, and this is a frequent happening. The total money supply in most developed economies has grown dramatically over the past several decades, far faster than the real economy. The actual goods and services being produced has grown. When money supply grows faster than real output, each unit of money buys a smaller share of real output, and this is inflation, not as a random event, not as a surprise, but as the mathematical consequence of a money creation system running continuously. Now, here is the specific impact on you. If you hold cash or keep money in a low-yield savings account, you are holding something whose purchasing power is being diluted every single day by the continuous creation of new money elsewhere in the system. You did not create any new money. You did not expand the money supply, but you are paying the cost of the expansion through the reduced purchasing power of what you hold. Meanwhile, the people creating and receiving new money first, banks, large borrowers, asset holders, use it before the dilution has fully priced in. They get full value, and you get what is left. And here is the detail that matters most. This is not illegal. It is not hidden in any meaningful sense. The mechanism is published in central bank documents. The Cantillon effect is in economic textbooks. The math is available to anyone. What is not available to most people is someone willing to explain it clearly until now. Here is what changes when you understand money creation. The first thing, cash is not a neutral store of value. It is an asset whose supply is being continuously expanded by a system you do not control. Treating it as your primary store of wealth means accepting continuous dilution, not risk, certainty. The second thing, assets that are scarce or productive respond differently to money supply expansion than cash does. Property, equities, productive businesses, these tend to rise in price as the money supply expands, because more money is chasing the same finite or slowly growing supply of real assets. Owning them is not speculation. In a money creation system, it is the rational response to a known mechanism. The third thing, understanding credit changes how you use it. Banks profit from issuing credit because they create money at the moment of lending and collect interest on money that cost them nothing to create. That dynamic does not mean never borrow. It means borrow deliberately for assets that appreciate, not for consumption. That disappears. If a bank can create money from nothing and charge you interest on it, the least you can do is make sure what you bought with it is worth more than what you owe. That is the minimum standard. Start there and let the understanding settle in. There's no rush. Banks create money from nothing. That is not a metaphor. That is the documented mechanism of the modern financial system and the consequences of that mechanism. Who benefits first? Who pays the cost last? How your purchasing power gets quietly diluted are running now in your savings account, in your grocery bill, in the gap between your raise and your rent. Now you see the mechanism, and you can share this with one person who has ever wondered why money feels like it does less than it used to. And if you want to keep understanding the financial system they built around you, subscribe to Hidden Truth Files every week. Hidden no more.